Today, New Zealand joins the exclusive cash rate hike rise club. Hello again, it's Martin North from Digital Finance Analytics, our latest post covering finance and property news with a distinctively Australian flavour. Well, it's happened. New Zealand's central bank raised interest rates for the first time in 7 years and signalled further increases will likely be needed to tame inflation, saying it expects the economy to recover from a coronavirus outbreak that is keeping Auckland in lockdown. The Reserve Bank's Monetary Policy Committee, led by Governor Edwin, lifted the official cash rate by a quarter of a percentage point to 0.5% in Wellington on Wednesday. That was expected by most economists and was well signalled. Current COVID-19 restrictions have not materially changed the medium-term outlook for inflation and employment, and capacity pressures are evident, the Reserve Bank of New Zealand said. The committee noted that further removal of monetary policy stimulus is expected over time, with future moves contingent on the medium-term outlook for inflation and employment. The move puts New Zealand at the forefront of the exit from ultra-loose policies employed by central banks during the pandemic, with only the Bank of Korea and Norway's Norges Bank having raised rates already among developed countries. The Reserve Bank's planned tightening cycle could be interrupted by the persistent Delta strain outbreak in Auckland, which is indeed hurting business confidence and dampening the growth outlook. The New Zealand dollar rose on the decision, then retreated, and now it's trading little changed. The Reserve Bank's dual mandate, targeting inflation and maximum employment, has well and truly been met, and rampant house prices remain a cause for concern, said Jared Kerr, chief economist at Kiwibank in Auckland. We expect today's rate hike will be the first in a series of hikes towards 1.5% and possibly higher. The Reserve Bank of New Zealand delivered the hike at an interim rate review rather than a quarterly monetary policy statement, meaning it won't publish new forecasts or even hold a press conference. The central bank was poised to raise rates in August, but then held off because New Zealand entered a nationwide lockdown on that very day of the decision. Most of the country has since exited the lockdown, but the outbreak continues to fester in Auckland, prompting the government to extend restrictions there, and it's also spread to the neighbouring Waikato district. The Reserve Bank of New Zealand initiated its last tightening cycle back in March 2014. They delivered 4 hikes in quick succession, but then needed to unwind them just a year later when the inflation that they were expecting failed to materialise. This time, though, inflation has already breached the bank's 1 to 3% target band. Already it's sitting at 3.3% in the second quarter. The Reserve Bank of New Zealand said it expects inflation to increase to above 4% in the near term before returning towards the 2% midpoint of its band over the medium term. The near-term rise in inflation is accentuated by higher oil prices, rising transport costs, and the impact of supply shortfalls. It said these immediate relative price shocks risk leading to more generalised price rises. At this time, measures of core inflation and medium-term inflation, though, remain close to 2%. Prior to the latest coronavirus outbreak, New Zealand's economy was in fact booming. Gross domestic product surged 2.8% in the second quarter from the first, when it grew by 1.4%, and the unemployment rate dropped to 4%, matching its pre-pandemic low, and house prices have surged by 31% over the past year. It's worth noting that they said, as required by their remit, members assess the impact of monetary policy on the government's objective to support more sustainable house prices. The committee noted the Reserve Bank's assessment is that the level of house prices is currently unsustainable. Members noted that a number of factors are expected to constrain house prices over the medium term. These include a high rate of house building, slower population growth, changes to tax settings, and tighter bank lending rules. Rising mortgage interest rates as monetary stimulus is reduced will also constrain house prices to a more sustainable level. Members noted a risk that any continued near-term price growth could lead to sharper falls in house prices in the future. The Reserve Bank of New Zealand said that it was aware that the latest COVID restrictions have badly affected some businesses in Auckland and a range of service industries more broadly, and that there will be longer-term implications for economic activity from the pandemic. While economic uncertainty remains elevated due to the prevalent impact of COVID-19, cost pressures are becoming more persistent, it said. New Zealand's public health settings are also evolving as domestic vaccination rates rise. The higher the vaccination rate, the less virus-related disruption there will be to New Zealand's economic activity over coming years. ANZ's Director of Personal Banking, Ben Kellner, said its own mortgage rate rise balanced its commitment to supporting people with their home ownership aspirations with the increase in the official cash rate and the bank's wholesale funding costs. ANZ will also increase interest rates on a number of savings accounts, but only by a lesser amount, either 0.05 or 0.1 percentage points. Asked to comment on why savings rates were going up by such a small amount, much smaller than mortgage rates, spokeswoman Christy Martin said it increased key term deposit rates by 25 basis points last week. ASB's chief economist Nick Tuffley said it saw the OCR climbing to 1% in February and to 1.5% by the end of next year. The Reserve Bank has made it clear it intended to keep lifting the OCR over time, he said. Tuffley described the central bank's review as more hawk than white heron, referring to a speech by Reserve Bank Assistant Governor Christian Hawkesby last month that suggested it could pick its steps carefully. ANZ sees the OCR reaching 1.5% by August through a cautious series of hikes. The awkward global theme was the risk of lower than expected growth and higher than expected inflation. ANZ said that meant the Reserve Bank was lifting off into a stormy path. It said, as has been the case for some time, the risks are skewed towards something coming along to derail the Reserve Bank's hiking cycle before its completion, despite extremely strong inflation pressures, it said. A National Party Shadow Treasurer, Andrew Bailey, said raising the OCR in the middle of a lockdown was incredibly risky for the economy. The Reserve Bank has seen that the cost of living is rising too quickly and its hand has been forced, he said. So if you are a Kiwi with a large mortgage, you may begin to think about the impact of those rate rises. But if you are a saver, don't expect much anytime soon. But this is definitely the trajectory that we're on. Rates will be higher for mortgages, and hopefully savings rates will follow shortly thereafter. But an interesting contrast now between New Zealand and Australia, where of course the Reserve Bank here in Australia is still saying there'll be no rate rise for a long time to come yet. I wonder whether they're being too conservative here, and in fact whether they'll be forced to lift rates earlier than expected. And in fact, the APRA announcement today could be seen as a harbinger of just that. So once again, it's worth reflecting that many people have not considered the possibility of higher mortgage rates ahead, and many people are likely to get caught. But of course, there is also the old question of whether that inflation out there is transitory or not. The longer it runs, the less likely it is transitory, the more likely it is inflationary. And given everything else, that sends a message to me that stagflation is more and more likely ahead. And that is not good news for anyone. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.